The other benefit of the app chain is that it's allowed my team to leverage this new operating model to scale across new asset classes. We're currently managing a crypto futures trade, and the reason we're able to extend this capability is due to the customization of the smart contract. Now, we can see all of the contractual details related to this agreement within this smart contract. But the main difference is that we're managing crypto versus traditional is the fact that we're managing against risk of a much more volatile underlying asset. And the margin calls are managed against a target ratio. In this case, it's 1.4. And my default ratio is 1.1, which means that I'll be liquidated if we're unable to cover this exposure. The real-time nature of this market brings more risk, but I can monitor in real time and use more stable assets as collateral to mitigate against this risk. In this case, I'm going to use stablecoin to cover the exposure. I'm currently holding USDC in my pool, and I can earn some yield when I pledge this. So I'm going to allocate 39 million in quantity. And as soon as I hit allocate, the transaction settles and I'm able to run down my deficit. So far today, I've been able to not only source US collateral before the US market opens, I've also been able to settle collateral with my CCP in real time and manage the volatility of crypto assets with just better risk management capabilities than I've ever been able to have before with more traditional collateral processes. My main benefit is that all assets are now in scope and I can move them as quickly as the network I'm settling collateral on allows. With the continuing market volatility, maintaining our cash reserves and HQLA buffer will help us support liquidity through the rest of the day. Mr. Watts, we've saved you some cash. Hope the rest of your day goes well.
She is D-I-S-C-O.
Mr. Watts?
D-I-S-C-O. Arigato Yalni-san. Very cool indeed. Very cool. And I heard cash. I do like cash a lot. But what are the outcomes our digital app chain has given us here? Number one, liquidity. Here we mobilize US Treasuries to Tokyo in real time with no settlement or market constraints. So if we're short of a specific asset type, we now have a global liquidity pool to mobilize from 24/7. Number two, cost and profit growth. Our collateral buffers have come down hugely thanks to that same real-time liquidity pool. In turn, this frees up large asset balances for investment returns. We're now making substantial cost savings over the course of a year. Significant profit growth for margin call, significant bonus growth for yours truly. Number three, scale. We've started to only scratch the surface here of the huge operational gains that smart contracts enable. And here we focused on near real-time inventory management and settlement automation. We've also avoided an external repo trade and the extra ops effort and settlement risk that brings. At Margin Call, we will continue to grow via expansion of our trading strategies, so operational scalability is a hard requirement. Now, the European markets are starting to wake up, so let's jet across to our friends at Margin Call Paris. We don't want to miss out. A bientôt.
In our second scenario, we see how tokenization can create operational and cost efficiency for segregated initial margin under uncleared margin rules, or UMR for short. The multitude of accounts and custodians involved creates inefficiencies in the way inventory is managed.